Yeah, this morning I just wanted to talk about a theme that we think will be one of the biggest macro developments for 2023, and that is really the reopening of China and the pivot back to prioritising economic growth. Look, it is the second largest economy in the world, and that has huge ramifications on global growth, just as we expect a period of weakness in the Western world. So it comes at a really interesting time. And even for us in Australia, we have 1.4 million Chinese tourists every year. There's 900,000 international students that study in Australia, and a huge chunk of that comes from China as well. So it has huge ramifications, not just around the globe, but also here in Australia. So what we saw on the 7th of December was essentially the Chinese authorities really taking a different tune towards how they manage zero COVID. And it's essentially backflipping on its zero COVID policy and dynamic clearing, and really paving the way for a full reopening. It's certainly come a lot quicker than we expected. And as we've seen with the rebound in Chinese markets, perhaps what markets were expecting as well. And that comes along with its own set of risks. A faster than expected reopening can mean, further disruptions in supply chains. We saw, supply chains disruptions even with a closed loop system in China. Now with essentially PCR testing, out the window and, centralized quarantine facilities, it's really opened the door for, a rapid wave of COVID through China. So it is going to be disruptive. And, there's a study that came out last week in Hong Kong that looks at the possible scenarios on how China gets out of this COVID wave and the likely duration of the wave. And it expects that peak really based on what they've seen in the Western world to really hit at the end of January, beginning of February. So you're looking about 6 weeks where that really accelerates before coming back down. So in the meantime, expect Chinese data to be quite weak. So economic data you'd expect to really continue to weigh down on the economic performance there. Also, what we've seen is the pivot away from COVID zero, but also the pivot away from taking a more heavy-handed approach to the property market. So over, until mid-November, really, you saw the Chinese government really cracking down on really indebted lenders, on how banks can essentially get their funding to fund these developers as well. So mid-November, they have relaxed quite a lot of regulation around that. So they've extended repayment terms, shadow financing, a term that was used before and they saw as a significant point of risk in the Chinese financial system. They have also relaxed restrictions on shadow lending. And then also the government has cut rates as well. So the PBOC has cut rates and also provided some loan guarantees to government bonds as well. So you can see here, clearly China is prioritising economic growth, perhaps over, some of the financial risks that are still brewing in the system. But nonetheless, it's good news for the property market there in China, and certainly good news for us in Australia, particularly with, iron ore and our biggest customer there. And we've seen already the iron ore price move quite substantially since this time. Also, something worth pointing out in China, the inflation issue is nowhere near as acute as where it is in the Western world. So inflation as of last month was running about 1.6% in China. So there's plenty of runway for growth, I guess, in terms of the Chinese government really stimulating the economy if it needs to. So to give you a bit of context, the US spent about 24% on stimulus of their GDP. China's sitting about sort of 5%. So we don't expect the same inflationary type problems that we saw in the US and in parts of Europe. So certainly plenty of runway for growth there in China. And if you look at, some of the consumption metrics that are key to this reopening and just how much demand can possibly come back in the system, I think these two charts really best illustrate that. On the left-hand side, it's the amount of savings that have been accumulated by Chinese households. And you can see there from February 2020, which was just before, March 2020, peak of COVID, till essentially last month, we saw a 38% rise in domestic savings. And if you can contrast that to retail sales in China, look, it's quite seasonal, but comparing it over that same time period, essentially retail sales has been flat since February 2020. So, not saying a lot of that accumulated savings would sort of find its way out into consumption, but certainly we expect a lot of that pent-up demand, much as we saw in US, Europe, as well as here in Australia, to find its way into consumption. And obviously the next question is valuation. How do you look at sort of Chinese equities? Well, you can see here that, yes, valuations have come back. They are still below its long run average. So the consensus expects earnings in China to decline by 24% in 2022 before rebounding 9% in 2023. We think again, like we saw experience in the West, this could once again prove to be conservative, because if you compare what happened in the US and even here in Australia, earnings declined 14% in 2020 in the US before rebounding 49% in 2021. The ASX 200 earnings declined 20% in 2020 before rebounding 39%. Now, given China's situation there, just forecasting really 9% rebound in earnings, I think is rather conservative at this stage, and we do expect that valuation to look a lot more attractive, particularly as we go through the year, as we get more certainty around earnings.